Welcome back to the Video CPA. I'm your host Michael Scott, and it's good to be with you again. Today we're talking about the tax aspects of home ownership, which should apply to almost everybody here. You know, I was thinking through all the homes that I had purchased with one of my sons the other day, and I think I've purchased and sold like 8 homes, and so you get to know this stuff pretty good after a while, but a lot of people don't know it, and so we're going to go through it today. So the first thing you'll see is as always, the disclaimer, and then we'll have the education disclaimer, and then let's go on into the actual tax aspects of actually buying the home. And there are a few things that you need to keep in mind when you buy the home. Any taxes that you pay at closing, any interest that you pay at closing. If those are not picked up by your mortgage lender in their 1098 at the end of the year, you can deduct those. If they are picked up, well, they're included in that amount and you deduct those anyway. The loan origination fees, discount fees, points, that type of thing are also deductible in the year that you buy the home. So you can take those as well. And then there are some items that aren't deductible, and those are your deposits with your lender, but those things are added to the basis, and we'll get into that in just a few minutes. So as you own the home, your mortgage expense and your taxes are going to be deductible. Now, interest has some limitations on it, and like I say, we'll get into that in just a few minutes. All right. More tax aspects of the purchase. You know, a lot of people don't save their settlement statements, but you need to save those settlement statements because many of the settlement costs on those settlement statements can be added into your basis. Now, is that important, you might ask? It may not be important. A lot of homes today are sold and the gain is entirely excluded. But it could be that they do come in handy. I mean, with prices rising and inflation the way it is, if you're living in a city today and living in San Francisco or Los Angeles, Chicago, New York, the prices of homes are just very high. And so you may fall into a situation where these settlement costs can actually help you reduce your gain on the sale. So keep track of your settlement costs. And so if you need a better understand settlement costs and get a list of them, you can look actually at your HUD settlement statement. But if you need more information, I'm not going to go into it in this video because I don't have time. Go out to the Video CPA Targeted Tax Training and take a class out there. It's free. There's going to be one on personal residence, sale of a personal residence, ownership. I haven't written the class yet, but it will be out there in a week or two, so just be patient and I'll get it out there if you need to know more about it. All right, so keep track of those settlement statements because there are things that you're going to add. There's also things that you add during the life of your home, like if you improve the home or you add onto it or something, those can be added into your basis. There are also things, a long list of things that you have to deduct from your basis, so again, if you need to find out more about that, just take the free class. Just go out and enroll in the course and take the free class. All right, the ongoing deductions, your taxes are going to be deductible. The only time that taxes might not be deductible is if there's a limitation on all of your personal itemized deductions. And in that case, part of your taxes would not be deductible, but taxes are deductible. Now, mortgage interest is a different animal. Mortgage interest is going to be deductible for your first home and your second home, but it's capped at $750,000 per year. Now that's in 2019. That may go up in 2020, we'll see. But $750,000, if you have a mortgage bigger than that, you can only take the mortgage interest for the amount up to $750,000. Anything over that is considered personal interest, and it's non-deductible. So that is something to remember if you've got a fairly big house and you've got a big mortgage. So let's talk about home equity debt. You can do that as well, and that also is limited by the $750,000. So if you got a mortgage and home equity debt that exceeds the $750,000, you need to you're going to have to kind of prorate your interest so that because you can't take interest on any amount over the 750. Now, home equity debt is sometimes taken out and then it's used for something else, and they do have tracing rules. So if you're using it in your business, you need to trace it away from your mortgage into your business and deduct it as business expense because that's a better deal. But if you're using it personally, it's not deductible. So you need to keep track of where that home equity debt is going and make sure that if it's going toward the house, it's deductible as mortgage interest. If it's going toward personal stuff, you're not getting anything on it. So keep that in mind. Now, the refinancing interest, they've got a limit on that. It's still subject to the $750,000 cap. But they also have a limit on it. If your mortgage right before you refinanced was $250,000, and you go out and refinance, and you refinance $300,000, for example, only $250,000 of it is going to be, the interest on that part is going to be deductible. The interest on the other $50,000 will not be deductible, and it's included as personal interest, non-deductible type interest. So make sure that when you refinance, you're just writing off the interest that's on that portion of the loan that was equal to your old mortgage right before you financed. So that's the rule on refinancing. I don't think there's anything else there that we need to talk about. Any of this stuff, you can't exceed the acquisition cost of your home. To build your home or to buy your home, none of these loans can exceed that. You can't write off any interest on anything that exceeds the acquisition price of your home. All right, let's look at the tax aspects of the sale of your home then. When you sell your home, generally the gain on your home is going to be excluded from tax. Now, some people ask me, how about the loss? Can I take the loss on my home? And the answer is no. I mean, they're not making you take a gain on your home, so they're not going to make you take a loss on your home either, okay? But there are some rules in order to meet that exclusion. One, you have to have owned the home for 2 out of the last 5 years prior to the sale. 2, you have to have lived in the home 2 out of the last 5 years prior to the sale. And 3, you must not have excluded a sale of a personal residence, an exclusion of a sale of a personal residence from tax in the 2 years prior to your sale. So that means if you had another home and you sold it a year and a half ago, and you're trying to take the exclusion on this home, they're not going to let you. If you sold it 2.5 years ago, you're fine. But so just remember, in order to qualify for the gain exclusion, that home that you're selling has to have to have lived in it at least 2 years and not having taken any other gain exclusion. All right, there are some exceptions to these rules, and there's exceptions to everything in tax almost. It's really great to be a tax professional. Very hard to keep up with, but if you're a military person, if you're a foreign service person, if you're a Peace Corps volunteer, and if you're working for the intelligence community, for example, you can suspend that 5-year period. You can't suspend it over 10 years, and there's some other rules as well, but just know that you can suspend that 5-year period. If you're mentally or physically disabled, then you only have to qualify 1 year out of the last 5 years in order to meet the test. And then the final one, well, this isn't the final one, but this is the final big one. If your home's destroyed or if it's condemned and you have to go live in another place, the time spent living in another place can be added to your time that you spent actually in your home to qualify for the 2 years in the last 5. All right, installment sales. If you decide to sell your home on an installment sale, you can take the exclusion that you get from the IRS, and that may be $500,000, it may be something else. But whatever that exclusion is when you sell your home, you can deduct that from the gross profit on your home when calculating your gross profit percentage. That means that your gross profit percentage is going to be much lower, or it's going to be zero. And if it's zero, then you've got no gain on your home. Either way, though, on an installment sale, you should have charged interest on it. If you didn't charge interest, the IRS may come in and impute interest on it. And that interest is going to be taxable. That interest is going to be taxable on Schedule B. So you have to include that interest on Schedule B and include who it's from, the address, the Social Security, number of who it's from. All right, so a lot of nuances in this area. It's an area that most of us are familiar with because a lot of us own homes, and some of us have had several homes, but there are a lot of things, a lot of exceptions and stuff. So if you need more, go out to www.thevideocpa.com, enroll in the free class, and I think this class is probably going to stay free. Most of them I'm going to charge for, and I'm going to do that pretty quick, but I think I'll offer this class just as a free class, since it applies to so many of us that are homeowners. All right, thank you for watching. Appreciate it. If you got any comments, leave them below. If you haven't subscribed, hit that button down in the right-hand corner. And again, if you need any more information on this or other tax topics, we've got a lot of real estate topics out there right now, classes out there that are almost ready to go. If you want to take one of these classes for free, they're in a beta state. You can take them. You can become a founding member of this particular school, which will get you all the classes at a discount. So keep that in mind if you're interested in taxes, or if you've got somebody that wants to become a tax preparer, because eventually we'll get there as well with the courses. We're just building them out. So, but if you are a founding member, we expect you to just help us, give us some feedback on the classes, some comments and stuff, so that we can improve them. All right, that's it. Thank you.